This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Coveil. Not filtered, raw, honest. That's my passion. My guest today might not be a well-known name in the trend-following world, but this guy swings for the fences. He is absolutely the kind of track record you would have seen coming out of the 1970s and 1980s. The kind of track record that made Bill Dunn and John Henry famous, that made Rich Dennis famous. My guest today is a repeat guest, repeating from 2014. Oh my gosh, 7 years ago. Don Wieczorek, Don's firm, Purple Valley Capital. I've actually had a lot of people ask me to have Don on because what he's been doing in the last, let's say, 14, 15 months in the trend following space is kind of like Babe Ruth on steroids. It's kind of nutso. And I say nutso in a good way. Without any further delay, let's jump right in and find out what this Babe Ruth of trend following has been up to since our last conversation 7 years ago. Oh, I can give you a hint. When you hear about his performance, you'll know what he's been up to. Without any further delay, let's jump right into my conversation today with Donald Wieczorek. I've been seeing the track record since we first talked in 2014. Now, 2014, I've got it here in front of me. 2014 was a great year for you, 87%, right? That's a fantastic year. But after 2014, and I see your monthly reports, after 2014, you took a steep drawdown. And I kept thinking to myself, damn, Don is laying it all out there on the line. He is completely sticking to his system. He's high risk, high reward. He's just gutting it out. Really, I probably would see your performance at least 6 times a year. We didn't really talk or anything or connect, but it was still, I would see the monthly performance report and it's very professional and everything. And then wham, bam, thank you, ma'am. Here comes 2020 and here comes the Don train bringing up the rear and lapping everybody. Huh? Pretty crazy story, right?
It's been a wild 5, 6, 7 years for sure. Because 2014, when we last spoke, I had a good couple years there and trends were around and a lot of futures markets were moving nicely. Just before I stepped into a 5-year drawdown there from 2015 to end of 19, it was a 5-year drawdown, 70% drop from the prior peak in 2014. And that was really, really difficult. There were no trends to be found. I mean, there was, from a financial economic perspective, there wasn't a lot of inflation. There wasn't really deflation. There wasn't a lot of economic growth or massive recessions. There weren't a lot of catalysts for large trends.
To take a step back, though, you are playing this game at a slightly higher level in terms of risk and reward than most, quote, traditional trend followers.
Correct. I do run an aggressive, high-octane, old-school trend-following strategy.
Let me tell people how aggressive and how high-octane that is. Don's 2020 performance, and again, I'm not an agent for Don or anything. Everyone knows I talk to everybody, all those past performance disclaimers and all that stuff and whatever, and it's all over Don's page and his performance. That doesn't obscure the fact that somewhere on file with the United States government will be your 2020 performance, which is, this is what a setup, huh? Drum roll, please, 193%. Actually, 193.2%. Now, I have a sneaky suspicion. Now, look, you're not running $1 billion fund, right? But that is still a number. And back in the day, there were a lot of guys in the 70s who cut their teeth, so to speak, on that exact same type of otherworldly performance. Now, maybe because of Bitcoin and stuff, maybe people or younger generations are starting to say, well, gosh, I don't know, Don's 193%. That looks like nothing compared to Bitcoin. I'm not sure how people are thinking these days. I mean, you start to come into 2020, January, okay, look, I'm in Asia. I start to know what's happening in January, right? Okay, COVID's hitting. We're already kind of doing masks and stuff. I was going to fly to Hong Kong, and all of a sudden they got canceled late January. And then boom, the hammer drops on the markets, or it starts to drop on the markets. Before people really knew what was going on, you were up 17% in February. Start to paint that picture, because it's almost like the birds that can detect an earthquake and they start flying, something like that. Trend following starts to detect something. So in February, before everybody else in America was losing their marbles in March, you already knew something was up in February in terms of the markets.
Right. Markets are, as you say, a little bit of a canary in a coal mine, so to speak, where I will start getting trend following trading signals, getting me into positions when markets start trending well before the masses recognize that a massive trend is happening. In February, equity markets started to roll over a little bit. Bonds started to creep higher. There was some stress in markets, which most of people just look at, oh, no, ordinary correction, no big deal. Let's buy the dip. And prior trends will continue. Whereas my strategy took these entries and shorting crude oil, for example. And there's a lot of these markets that were reversing trend where we started initiating positions and did well in February. And then March is when it really happened. That's when equities really started collapsing. And here in America, we started closing down economies.
March 2020 was your biggest month ever?
Correct. Yes.
And you made 56.5%. It's just fun to say these numbers, right? I mean, it's almost like cartoon-esque, isn't it?
Oh, you're telling me after 5 years of a drawdown, I was ecstatic. Just rewind 4 or 5 months. I'm talking to other trend followers saying, I don't know when the next trends are going to come. It's been 5 years of no trends, and I don't know where they're coming from. I don't know when it's going to happen. I mean, 5 years of a drawdown, that's like 2,000 days of me waking up saying, hey, we're still in a drawdown. I don't know when the next good environment's going to come.
Again, though, when you say drawdown, I just want to be clear, because I've seen some other track records that you are at the tip, so to speak. You're in the car and you're driving very fast.
Right. I mean, we're with risk controls.
Of course, you're not a riverboat gambler. You picked this game. You knew what your risk controls were from the beginning. You probably modeled yourself after some of these classic guys. I wrote the number down while we were talking. I was thinking, okay, what was Dunn's max? I think Dunn's max, right down the road from you in Stuart, Florida, I think Dunn's max was 67%, I think.
Correct. In a similar 4 or 5 year drawdown or so, it happens in trend following. And I run aggressive. Sure, it's like driving a sports car, but I'm still only going 15, 20 miles an hour, which is hard to believe. I'm 70, 80% cash most of the time. That's what's crazy is I'm only using 20, 30% of my margin to trade. That just goes to show how much firepower futures trading allows or commodity trading gives you. And unfortunately, why so many people blow up and can't last more than a year. They give me a bunch more firepower and I can't use it, obviously, because I'm already running super volatile.
What happens, though, now? I can see your assets have not changed dramatically since we spoke last. You're still kind of trading friends, family, maybe a few pros have kind of jumped on board, but your assets have not changed dramatically. Have people started to talk to you a little bit different, though, now that you've navigated 2020?
I'm $7 to $8 million now, which is great relative to the small amount I started in college with when I launched it after graduating.
100,000?
Right. Yeah. So I can make a job out of it now.
That wasn't a knock. I was not knocking. I was just putting things in perspective. Most people want to do what you're doing, right? Most people, maybe they never get to be the size of David Harding, 30 billion. People like the idea of being a Don, being you, because you get to do your own thing. I'm guessing you'd probably see the family a lot and you're not really probably checking into an office that you have to drive your car to, I'm guessing.
Right. And I remember Ed Secoda once saying, when people ask him, how to become a trend follower, how to run a big fund. And Ed said, just take out a blank sheet of paper, write down what you want. Just be honest with yourself because you may actually achieve it. That's what I always was honest from the beginning and said, I run a fund or a strategy for my friends and family and others that believe in it and want to stick with me. I had limited interest in huge institutional investors who just by nature of their job, they can't invest in a strategy that's going to have multi-year drawdowns like me. And that's why I'm still here. Like, that's why I'm still alive and didn't close down like a lot of funds.
You didn't take the wrong kind of money, meaning the money wasn't going to run away from you the moment something happened.
Right. Because you mentioned David Harding. I mean, he came out a couple of years ago saying it's just tough to be in those shoes when you have a lot of institutional investors. A lot of guys had to change their strategy and they had to come out and say, trend following is dead. We don't think trends are coming back. We need to change things, add more equities, get away from trend following. So there's a lot of managers that had to do that because they had the pressure from big institutional investors and they had to do it to stay alive. I was lucky that, yes, my assets haven't changed a whole lot. I was just trying to stay alive.
Okay, you did that. You're alive. That's why we're talking, because it's a fun story. You passed the threshold.
But it's hard.
Okay. What did you do during the middle of this thing? Who were you talking to? Was there any kind of pearl of wisdom, any mentoring, or was it Don in Jacksonville sticking to your knitting? Did you do anything special during this time?
I would read a good amount. I mean, I would go back to your books. I'd go back to Dakota's Trading Tribe website.
Paid advertisement, of course.
But I mean, that's the key, trying to look at what other successful trend followers have done and how they get through these drawdowns. David Drew's out of Hawaii, similar sort of strategy, and just remind myself that drawdowns happen, negative stretches happen. There's no need to really change. And that's what's hard. It's unlike sports where in golf, if you miss a bunch of cuts and you're struggling, and you should start trying to make some changes sometimes, trying to get better because your goal is to get better and make a cut every weekend and try and win tournaments. But trend following, it's like you have to fight that urge to change things. I'm supposed to, by definition, I'm supposed to go in drawdowns. I'm supposed to have tough patches. I'm not supposed to change things. So I just kept reminding myself, the main thing I kept reminding myself and talking and sharing with my investors and clients was that, yes, we're in a tough stretch. I understand why. There's simply just no trends. What I want to do is see this through and see how I do in a good environment. There's going to be a good environment again. And I just want to see how I do in a good environment. Because if I perform poorly in a good environment, then I'll start rethinking things.
I tell you what, we watched this situation where the United States Federal Reserve, I mean, look, they've been talking about helicopter money forever. I think we're at 747 money. It's no longer helicopter money. They've got like armies of 747s. The printing machines are in the air dropping the money. There's some people that actually think this all just works out in the wash, so to speak, the modern monetary theorist. And I know some and very smart people, because I think this is what's really going on. If America can essentially just say, we've got a lot of nukes, we're going to do whatever the hell we want to do, and we're going to debase the dollar anytime we as a country get into trouble, and the rest of the world is just going to have to suck on it, so to speak. Eventually, that might not be a strategy that works. And I got to tell you, if that strategy ever does stop working, not a prediction from me, I think you're 180 or 193% in 2020. You might be the first trend following trader to have over 1,000%.
I was talking to my wife the other day. Given the current economic environment, if I was today trying to create any kind of investment strategy for the next 5 to 10 years, I would create a trend following commodity futures strategy. Like, I really do think the next 5, 10 years will be wonderful for these sorts of strategies, because we're entering kind of what you're talking about, almost like a bubble economics. There's going to be massive moves and trends almost everywhere. And we're seeing it express itself in a lot of areas now, whether it's Bitcoin or GameStop or these SPACs. I mean, there's just the Fed incentivized and wanted people to go reach for yield by keeping interest rates so low that's what they did.
Bitcoin is a big reach for yield, that's for sure. People are getting rewarded with it. I got to figure that for younger generations that are now growing up, so to speak, with the Bitcoin volatility and the Bitcoin gains, I got to figure your track record and your performance is going to be a lot more palatable to people that are under 40, under 30 than perhaps the baby boomers that are sitting around praying for their 0.5% yields.
Right. Yeah, I agree. I mean, most of my investors are younger and more risk tolerant. And I always pitch my sort of strategies as a diversifier anyway. It should be a small part of people's portfolios who have stocks and bonds already. But volatility doesn't bother me. I think of volatility as very different than like risk, in the sense where risk is the chance you're going to lose your money, where volatility is just the variance around an expected return, where volatility, I need that to jump higher. I think of it almost like an elevator, where like an elevator needs to go up and down to reach a higher floor. That's volatility, where risk is, hey, how well is that elevator made? How strong are the cables? Like, what's the risk of that elevator crashing and breaking? That's risk. So it's like, if you make a really good elevator, the volatility doesn't bother me.
Let me question you on something here. You will probably like where I'm going to go here, even though you've been trained not to say it, so to speak. If I'm looking at your stats correctly, from inception, your inception, 2008 until today, this is at the end of February 2021, your cumulative return 592%, the S&P cumulative return 291%. So explain to the average Joe out there that if you're coming close to doubling the S&P in this nearly decade window, why would they only give you a small percentage? See, I've always wondered about this with trend following. I think everyone's got to train to say, well, if you got 100% of your portfolio, only give us 5%. But the reality is, if I'm reading your numbers right, and you're going to tell me if I'm wrong, the reality is somebody would have made a lot more money with you than the S&P for the last decade. Is that fair?
That is fair, but I would have give them a couple stomach ulcers, I imagine.
The S&P also had a major meltdown in 2008. The S&P hasn't had its big drawdown in the last decade. We're on borrowed time. So what is your performance going to look like when the S&P finally does have its next 50% typical drawdown, which it really is typical in the S&P? How are you going to look by comparison? Now, look, we're not making predictions here. You and I know generally what happens when stocks take a hiccup and drop 50, 60, 70%, we generally know what happens to trend following traders.
Right. A lot of new trends are created and we can create that crisis alpha. Usually we have a good historical ability to do that.
Stay hypothetical with me for a second. So here we are at a cumulative of 600% to a cumulative Purple Valley, your company, your firm, to a cumulative S&P 300%. Now, will you only be telling people if the S&P drops 50% and you go up another 100% or something? Would you still be only telling people that you only get a small piece of their capital?
When you blend the two, that's what's beautiful. You even get something better. That's where I like all of it, to be honest.
From a risk-reward standpoint, you mean the blending?
Exactly. And it gets back to the stomach ulcer thing. As well as my performance has been now looking back at it, like I still had investors take out at the bottom saying, I just can't stomach it anymore.
Do you have any of the people that took money out at the bottom? Are you friends or associates still with them?
I am. They check in once in a while. They're good buddies, but it's just purely a stomach thing.
You're buddies with folks that took it out at the bottom. I know you're not a jerk or anything, so you're not gonna you're not gonna rub it in, but they took it out at the bottom. They know where you are today, or do you have any knowledge they know where you are today?
They do. I mean, they get the same monthly updates that you do, and they respond and say, wow, that's awesome to see you coming back.
Even after they took out at the bottom.
Right. It's a pain threshold. That's all it is. I mean, look, the drawdown was worse than I ever thought it could be or imagined.
Let me keep it at these people that got out of the bottom. What have they said to you? Have they said anything prescient to you, like how they feel now to watch almost a full decade cycle of you in action, your system in action? Of course they regret. What do they say?
Well, what's interesting is now they say, is it too late? Have they missed it? Like, is it too late to get back in?
After you've made 200+%
right.
in 2 years.
That's what makes me realize I just need to stick to it and what makes it work, if that makes sense. Knowing that the psychological elements exist in marketplace, that's what kept me going the last 4 or 5 years during the drawdown. It has to work again. There has to be trends again because these psychological matters exist in markets and always will. Those same books that were written 150 years ago or 100 years ago, all those reminiscences of a stock operator, all those truisms still apply. And that's what I kept getting back to during the depths of the drawdowns, is that there will be trends again. To be honest, the clients that do the best are the ones that almost forget about it. They put in from the beginning and they just forget about it and they check once in a while and that's it.
Everyone is upset now they didn't buy you at the bottom, huh?
Well, it's hard. I would email people and try and get people involved, but who wants to put money into somebody who looks like they're almost circling the drain?
We have a name change at Purple Valley. It's now Circling the Drain.
Yeah, well, it's like, some of the biggest names in trend following, we're all saying trends may be done. This is a new era. Like the Federal Reserve's not going to allow trends to happen. I'm
sure some of the people that would be good contacts will reach out to you after this conversation, I'm sure. And I'm sure some people will think, even after they look at your track record, they'll think, oh, I want to participate or something. And they'll be the wrong person. They just will not get it because they're only going to see the last 2 years. They're not going to be able to wrap their arms around it. How do you filter for people? Because essentially you're having to kind of filter a personal psychology. You've gotten good at being a shrink, I'm guessing.
That's where I try and start. Like I try and explain and set the expectations. Where I run into trouble is when people have the incorrect expectations, thinking that this performance is going to last forever. I'm going to make money every year. And I try and set the expectations that no, like there's going to be drawdowns. They're going to be deep. I am aggressive. Try and stay invested in these sorts of strategies for a minimum of at least 5 years to try and realize the potential for them. And what's really hard is trying to get them to really understand those drawdowns, like 5 years or 4 years or 3 years. Like those are, you can't just look back at a track record like you and I are doing now and say, oh yeah, it was just 3 or 4 years, no big deal. Like, look, he got out of it. Living through that is so different than just looking back.
Fair enough. But I got to tell you, when you look at what's going on with Bitcoin, when you look at the acceptance, and Bitcoin's been going on for a decent stretch now. How many of these big Bitcoin drawdowns have there been in the last 7 or 8 years? A lot. And so a lot of people have really, what's the acronym they use? HODL, hold on forever or something, right? So it's interesting. And people can hear this in your voice. It's like, okay, on the Bitcoin side, they don't say any of the things that you're saying. They're just like, hey, man, this is, you only live once, let's go for it. I know that's somewhat because of the regulatory environment, somewhat of how you have to talk, and maybe even somewhat related to baby boomers. But I'm telling you what, this Bitcoin generation, I love the fact that they're just saying, whatever, man, let's do it. Let's go on it. Look at GameStop, all this craziness.
Right. And that anti-establishment, anti-Wall Street kind of mentality. I mean, that, to be honest, trend following is a little bit of an anti-establishment, anti-Wall Street. I mean, we're not predicting anything. We're not reading the news. We're not trying to do anything fancy or special. That sort of mentality can do well as a client for trend following. And I like that kind of, it meshes well.
If I look at your track record right now, okay, yes, you can lament to me, you can say what it feels like, and you can say it's a steep drawdown and all this other kind of stuff. But when you look at the track record, there it is. There it is. And everyone can look at it and say, okay, there's a decade of this guy, Don, in Purple Valley, his company. The risks and rewards they're right there on the piece of paper. You can say, well, the downside, the drawdowns. But the reality is a lot of people are going to say, well, damn, if I would have had that guy for the last 10 years, he's twice as nice as the S&P.
Right. I'm proud of having stuck through it. I mean, that was my third drawdown, and I've had 4 or 5 really good runs to the upside. I'm proud that nobody can ever really take that away from me. Like, I can always look at those numbers. They're audited, established, and real money.
Do you feel a little bit invincible now? A little bit that you've walked to the edge of the abyss?
I feel a lot more confident trading now than I did when I first started. I'll tell you that.
No one else in the world publicly that I know of has a trend following track record that looks as aggressive as yours, up and down. Again, I tell this to people all the time in my podcasts and my books. Go check out old track records of trend following traders. You can learn a lot. Your track record looks exactly like all of the legendary traders that started in the 70s.
That's what I'm excited about. That's what I tried to create. I read a lot about traders in the 70s, and I tried to create a strategy that would perform similarly, given the 70s were a fantastic environment. And I think that we may be on the precipice of another inflationary environment similar to that over the next 5 to 10 years, which is why I'm super excited about the next 5 to 10 years. I'm proud of being able to look at my strategy and say, sure, there's some tough drawdowns there, but that's to be expected if there's no trends.
I got to get you to stop talking about drawdowns. Okay, we might be in the You just made 193% in 2020. At the end of February 2021, you're up 44%, and you're talking about drawdowns. 200% freaking in 14 months?
I sit on my hands during those periods. The good times take care of themselves. This is the last thing I guess I'll say about drawdowns. That's the hard part. That's what takes the energy, that takes the mental capacity, that takes the discipline. The good times and the good trend environments like we're in now, I mean, that's the simple part.
You talked about we might be on the precipice, as you say, of an inflationary environment. Now, I want you to, as you say that, and I can concur, that's a fairly decent hypothesis. Why not? That makes a lot of sense, given if anyone understands what's going on with the economics out there. However, as you say that, I want you to be clear with the audience out there. You are not taking that opinion that you just stated, and it does not enter into the performance that we've been talking about in this conversation. Meaning you've got this independent opinion over here, but that independent opinion is not somewhere in the gears and the levers of your trading system doing something.
Correct. I can have a lot of opinions or thoughts about certain markets, but they're totally independent of the trends I'm capturing. For example, Bitcoin. I've been long Bitcoin. The strategy's been long Bitcoin, and it's done really well. But who knows? In my personal opinion, I may hate Bitcoin. I may think it's a terrible in a bubble and collapse today. My personal opinions do not factor at all into trend following. They're interesting and fun to talk about and to discuss with people. But as I get older and more experienced in this, I read less. I have less opinions. I just want to capture trends for people.
Bitcoin futures, right?
Correct. Yeah, Bitcoin futures.
When did you decide to add Bitcoin to your portfolio mix?
I added Bitcoin futures when the CME brought them out about a year and a half ago. And I just added Ether futures when they came out about a month and a half ago. So, I mean, I like the market in the sense that it adds diversification to the other markets that I trade, the other commodity markets I trade. And I do think Bitcoin futures has the potential to go down as one of the biggest bubbles in history. It has amazing properties.
As you say that, remind the audience about, okay, you've been long inside your portfolio structure. In your trend following portfolio structure, you've been long Bitcoin. As you say, it could be a massive bubble. Remind people how your strategy would play out if Bitcoin starts to go the other direction.
Bubble doesn't scare me as a trend follower. At the end of the day, trend following is all about trying to capture big moves or bubbles, as George Soros says, is one of the best ways to make the most amount of money. So we want to be in bubbles. We want to try and capture big trends. As Bitcoin goes up, we'll be long. We try and be long-term enough such that these recent corrections over the last couple of months don't knock us out, because you never really want to lose your position in a bull market. By any definition of a bull market, Bitcoin isn't a bull market. There's only one correct position to have right now in Bitcoin, and that is to be long. So we'll be long until my strategy says the move's over, at least intermittently. So we'll get knocked out after it turns, for example, for a couple months. Like, it has to go against me for a couple months or so for me to get that exit point, at which point the next move may be short and then be able to ride that move lower. I don't like being short markets just because from a math perspective, the risk reward isn't as great as being long. You just don't, the profit potential isn't as much. Collapses can happen a lot faster than moves up to the upside.
Give my audience, going back in time, pick 3 of your favorite legendary names. I'm guessing some of them will be people that I've covered in my books, perhaps maybe other ones I don't know. Talk to me about 3 legendary names that maybe you've not even met, people that have inspired or influenced you.
First and foremost, Ed Seykota, who did trade through the 70s, was aggressive. Records of, I think, averaging like 100% a year for 10 years or something ridiculous. Super wise trader who, and he still runs and answers questions on his website. And I learn something every time I go to it. I just went to it the other day. So Mr. Ed Seykota, and then one of his disciples, David Drews, who's a trend follower out of Hawaii, who was an emergency medicine physician turned trader, I think in med school or once he became an attending.
Have you had a chance to meet either of them?
I spoke to both of them briefly on the phone years and years ago. I remember when David Drews called me, it was I was on East Coast time. He called me from Hawaii at 11 p.m. and I just jumped out of bed. And my wife kind of joked, she's like, "Why are you jumping out of bed?" I was like, "Oh, Dr. Drews is calling. He's actually returning my phone call." I'd emailed him. And this is when I was new. I mean, I was trying to just pick the brains of some traders. Since then, not really. We all beat to our own drum. We all found strategies that we created ourselves and we stick to. I'll email them every so often just to say, "How are you doing? Good to see you. Everybody's still trading and congratulations, went on a good year," and things like that. But not so much picking their brains for advice anymore. Like, we all get it. It's as we all get older, it's more about just sticking to our own systems.
I think you were saying number 3 was Bill Dunn.
Correct, because he runs a slightly longer term strategy, I believe moving averages, and his drawdowns also are deep, and he runs an aggressive strategy, and he's just bigger in terms of assets. And I think he does a good job with marketing and growing the business side of it. So that's something I kind of admire about his fund. As a 4th, I'd throw in Salem Abraham. He was instrumental initially when I was first starting. I was trying to read and learn about his strategy and his fund. I think recently, he's an example of somebody who I think is more switched into more equities now, because trend following wasn't working so well, and now he's blended it with a lot more equities. So there's been some movement there. David Harding, he's done some movement away from trend following.
They train all trend following traders to lament the worst of everything. And again, I'm looking at 193.2%. Some people might be listening and thinking, "God, that guy Don, he sounds really unhappy about some of his performance. It's not very good. He's having a hard. It's a hard time. It's a hard time."
I'm just trying to keep my regulators happy. I have to be balanced.
I don't fall under the purview of those guys.
Yeah, I understand. Past performance is not indicative of future performance. Don't get me wrong. I can't be more excited about the next 5-10 years. I think what the Fed has done, just like you said, spraying money around it, it only ends in one of 2 ways. It's either going to be a debt crisis or massive inflation. The inflation is much more palatable from a political perspective.
If the regulators are listening and they're upset with you, all I can say is I'm looking at your track record from 2008 to 2021. I'm looking at every month. I'm looking at a lot of positive months and I'm looking at a lot of negative months. I'm looking at every month. I implore everyone out there, because it is a great educational lesson, especially for budding traders, to go look Purple Valley Inc.'s track record. Really, it's a fantastic lesson, because if people can actually figure out what you've done, they've learned something. And look, there's going to be some people out there that can figure it out to some degree. They're going to be able to, it's going to take them a little bit of time. But, if somebody says, gosh, I want to reverse engineer that guy, Don, that'd be a worthy homework assignment, wouldn't it?
Sure. Your book on the turtles. I mean, that's a good place to start too. That's where I started back in the day. I mean, reading about the turtles and trying to develop long-term trend following strategy across futures. A lot of our performances will all be correlated, the trend followers, and our performance is mostly a function of our exit points and how long-term we are. In good times, we're all catching the same trends. And it's the same things are moving, like Bitcoin's moving, the grains are moving now, like everybody's short bonds right now. The performance is more a result of how short-term we're getting into markets and then where our exit points are. And mine, I just tend to be more, medium term relative to say like Dunn Capital. And I'm more aggressive. I'll risk about 1% per trade.
Is there a side of you when you're on a conversation like this and you're talking to someone like me who's talking quickly and throwing a lot of things out there, is there a side of you as you're running a fund with regulators always paying attention to what you're doing? Is there a side of you that gets concerned about saying things, even about things that are factually true? Your track record is factually true. It's on record with the government. People can do a freedom of information request and get the damn track record. But sometimes the government doesn't want you to talk about it. Have you been trained to feel some angst when you talk to someone like me?
A little bit, but I've gotten used to it over the years. It does make it hard from a business perspective to go try and raise money, and what I can post online or what I can say or what I can do in that regard. It doesn't affect me that much because I don't love doing that anyway. Like, I'm not a big marketer. I'm not a big business person. That's a whole half of the brain that I'm not very good at. I like the math, I like the trading, and I like creating the track record. And then I let that kind of speak for itself. When I talk about it, I need to be a little careful. I like talking about it. I mean, it's interesting. Like, I think trend following is a phenomenal process of trying to capture trends. And I like commodities and futures trend following because it gives me access to a wide range of markets. Ever since I was a little kid, I always wanted to be in whatever's moving, whatever's hot, like whatever's making new highs or new lows. By definition, like, we're in those things. If you pick up the paper today and see some things hitting new highs or new lows, you can rest assured that my strategy is in that. And I think that's really neat.
Let me give people a quick rundown. And this could be a little bit dated, or at least 30 days dated from your last report. Long the Aussie dollar, long Bitcoin, long British pound, long corn, long cotton, long crude oil, long heating oil, long live cattle, long NASDAQ, long New Zealand dollar, long Nikkei, long gas, long the S&P, long soybeans, long soybean meal, long soybean oil you were long, long sugar, short the bonds, short the euro dollar, short palladium, short the US dollar. So that gives people an idea of what's going on, or at least how a strategy like yours, the types of markets that you can be in, a combination of up and down.
Right. I mean, there's some environments now where we'll be long more often short, but back last year in March when COVID was really hitting, you can almost flip all those. We were short a lot and then long US dollar, long bonds. So it's a nice diverse group of markets. And I like that. So, at any given time, there's usually a couple things that are really moving. Right now, there's a lot. And that's why you can put up these years like this.
Are you in all of the markets I just routed off, either long or short at all times?
No, I monitor about 40 to 50 different commodity futures markets. And at any one time, I'm anywhere between 10 to 20 of them. So those are the ones I was in at the end of February. A few changes have been made, not very many, but I'm only in whatever is moving, which is usually about a third or a half of the available markets. Because they're not all trending at one time. And I don't want to be in ones that aren't moving. Some guys like to have either a long or a short in all the different markets. That kind of dampens their volatility and their returns. I like to be in just the ones that are moving and just the ones that are moving a lot.
I sound like an aggressive prosecutor in this conversation, just pummeling you with questions and thoughts and whatnot. I brought up the idea of how people in your world, clients, felt when they got out at the bottom and then saw everything zoom back up. You must have a handful of folks, at least, who have been in for the full ride. They must think you're like a rock star now, huh?
They like it. And a lot of them are friends. So they're more just proud of me that I didn't quit. They're excited to be a part of it. And they like the story. They like having access to the markets. And they like that we're up a lot. It's almost like trend following in itself within my own client base. I'm left with now a batch of just really good winning clients. The clients that it wasn't a good fit for, they kind of weeded themselves out. And now I'm left with just these ones who it really meshes well with. And it was interesting to see when people took out. There were some that took out right at the bottom. There were others that took out once they got back to break even. And they said, okay, I wanted to just make my money back of the last little drawdown. As soon as we get back to even, I'm out. And then there's others that have now captured a lot of the upside after that. It's very similar to just how markets in general work and the dynamics of why people lose consistently, why people win, and kind of how I created the trend following strategy to begin with.
Is your filtering process for clients kind of like what you've done in this conversation, where you talk about the drawdowns and how much pain it is, and that you can't sleep for 5 years and you can't use the bathroom and all this other kind, you can't eat, you've lost 50 pounds? Is that kind of what you tell all new clients now? They don't get any of the enthusiasm I'm bringing, right? So now you need to turn them on to the podcast and say, well, listen to this crazy guy somewhere in Asia who seems to like what I do.
Right. And then if they still want to talk to me after that, I'm like, okay, now you've made it through the pain part.
I mean, is that your filtering process? You are literally trying to scare people away from being your client. Is that a fair assessment?
It must come across that way, I guess. I've never looked at it that way, but I don't think you're wrong. I try and be as honest as I can about it.
Don't be my client because you might have a chance to do twice as good as the S&P over the next decade, like I've done over the prior decade. Do not become my client. It's like a tagline for your business. I might beat the S&P again by double. Do not become my client.
But it's the upside's there if you have the patience and discipline for it, right? I mean, that's just how it works with everything. If you really believe in it, have the patience and discipline with it. I find it easier for myself because I created the thing and I can see it every day working. I find it easier for myself to obviously stick to it. I don't feel bad for clients, but it's harder for them. I understand it's harder for them to stick to something that they didn't create, that they don't see day to day. They may not understand as much as you or I do about trend following. It's kind of difficult there. You know what I mean?
The part that I think is so interesting about looking at your track record, and again, I implore people to go find you, even if they don't become a client. I mean, maybe you don't want to talk to them at all, but I want people to go look and study your track record. There's so much informational, educational potential to it. But the interesting thing, and I've said this earlier in the conversation, is that you have taken a drawdown and had this kind of full cycle, so to speak, over a decade. And in that same window, the S&P has not taken a hit. So you have blown past the S&P, taken drawdown, and the S&P is on. Somebody goes to look at somebody like fund manager out there, John Hussman, who uses a bunch of fundamental measures and whatnot to look at things. Like, we're at the most elevated position on the S&P in the history of America. So it's really interesting in that sense. What people really need to understand why I'm saying that is, if you look at, this is not a PSA for my book, but if you look at what happens when the S&P does have its big meltdowns, trend following does exceptionally well because all the other markets start rocking and rolling. So this is what you have done here in the last couple of years on trend following could just be the beginning if the S&P ever does, if it's ever allowed to come back to earth. Now, again, we're theorizing here. Who knows? The Fed might keep it elevated forever and just bring the dollar down to zero right there to match interest rates. Who knows?
I think you're onto something there. And again, that's why I'm so excited about the next 5-10 years is because we could potentially be in an environment where equities get hammered and also bonds. Remember, bonds have been in a bull market for 3 decades, since the 70s when rates were so high back in the 70s. And then rates have just fallen for 3 decades.
Maybe baby boomers, as they get a little bit up here in age, you're going to say, you know what? We're tired of being at the equities casino. Can we have interest income again?
Right. Bonds are that whole 60-40 stock equity bond portfolio is going to be coming under pressure. It already is a little bit. Where if we get an environment of stagflation, for example, where equities and bonds get hit, and all of a sudden we get inflation where commodities start ripping, it's that's why the strategy, trend following commodities, I'm super bullish on it for the next 5, 10, 20 years. It could be incredible. Money moving into these assets. Money has been just flowing into equities because the Fed basically has incentivized that to happen. And bonds. And now that all that money, trillions of dollars, has to flood somewhere else. And it's going to find a home somewhere. It's finding a home in commodities now. It's finding a home in Bitcoin. It's finding a home in housing.
Here's a way to look at it. Everyone's seen The Big Short. Everyone's seen Christian Bale playing Michael Burry, right? So everyone knows what the story was up until 2008. All of America. We watched the damn thing. Here's the funny thing is, apparently America doesn't think anything happened after 2008. So Michael Burry explains everything and shows his explanation through his performance through 2008. Well, guess what, kids? There's been a lot of hanky-panky since 2008. And, somebody's going to make a movie in the future when the hanky-panky comes, when the bill comes due, they're going to make The Big Short Part 2.
Exactly. And it happens every 10, 15 years. It's just like clockwork. People have short memories. Day trading speculation going on now where everybody's making money. Like Buffett says, the tide will go out at some point and you'll see who's swimming naked. And hopefully trend followers will be there to capture the big moves when they happen. Getting back to your last point about how the last 10 years, like I was able to do well, even with the S&P doing well. I think that's interesting to talk about because I think there's a little bit of a misnomer in trend following that we only can do well when there's market crises. Yes, we can tend to do well during market crises because big trends happen, but we can do well even when stocks go up. And I think that's what's interesting is we're totally uncorrelated. We're not perfectly inversely correlated. We don't just do well when stocks do poorly and vice versa. Like we can still do well when stocks do well. And I think that's kind of lost a lot in the managed futures space.
I just almost had an aneurysm there. You use the term managed futures. I haven't done enough trend following podcasts in the last handful of years. I'm going to have to do more, but that term managed futures, oh my God, can we just... I guess, look, the thing is you don't want to use trend following. You know why? Let's be honest. Why do a lot of people not want to use the term trend following? Because then they all just come to MICHAEL COVEL and do some things. We need other terms. We had time series analysis, momentum, and managed futures. Anything to get away from the core term that everyone knows called trend following.
Right. Cut losers, ride winners, and just stick to the system. That's it.
Are there any other influences or things that you like to read, psychology? What are some of the things that drive you and keep you kind of balanced?
It's not so much the reading anymore. I mean, there was a lot of reading done initially. Now it's just keeping me balanced in a whole life perspective. It's I got 2 young boys now, married. So I run around chasing the kids around a lot and keeps my mind off staring at markets going up and down every day because it's really random in the short run and you can waste a lot of energy and get yourself in a lot of trouble if you're trying to watch markets all day long thinking you can do stuff.
I can't imagine you're watching markets all day long thinking you can do stuff because you can't.
No, right. But a lot of people do, and they get into trouble, especially during the drawdowns. And they feel like they need to be making changes and tweaking things or getting in or out of certain things. So for me, it's fishing. I'll try and go out fishing and golfing quite a bit. But I like fishing a lot just because it's similar to trading in the sense that, outdoor sports, like they're unique in that they lack organization. Like I can't control where the fish are if they're going to bite. I just need to be there. I need to be in the river and there every day or as much as I can. If you want to be a productive fisher, like trend following, you got to be there every day and just put yourself out there. And when the conditions are right and they're there, you can capture some big ones. Trend following, for example, is like bluefin tuna fishing, where you just catch a couple big ones every year and like that'll make your whole year. This isn't like bass fishing or bluegill fishing where you're catching a lot of little fish all day long and you're making money every day. This is where you're going to go out and may not capture something for several days or weeks or months at a time. But when you do, it's huge. And that's what's so fascinating about markets is you can get these big outlier fat tail type moves. And I just need to be around and stay alive and have all my hooks in the water to catch those big ones when they happen. So for me, it's fishing and just kind of being outdoors and grounded and talking once in a while to some other trend followers. Again, not as much as I used to because I have that confidence now. I've been through so many cycles of this that there's nothing really that somebody can tell me that's going to change anything anymore. I have my system. I remember Ed Seykota saying this so poignantly that like the system is made up of 2 things. It's the actual trading system and then your ability to stick to it. And those 2 things have really been stress tested the last 12 years I've been doing this, where I feel really good about it. There's very little that markets or the world economy can throw at me now where I'd feel uncomfortable. I've already gone through those. I feel comfortable and now it's just trying to relay that confidence and comfortableness with my clients and making sure that they feel similarly so we can kind of just stay on this ride forever.
You were talking about the screen and not being glued to the screen all day. And, sometimes I see pictures and people show their, I don't know, it's just something randomly online. I'm not doing any of this kind of nonsense, but I'll see some people, they'll post their trading station or something, and it'll be 6 screens on their desk and they're talking about their day trading and their discretionary trading. And I'm thinking, okay, I'm a human being. I have 2 eyeballs. And I've got a desk in front of me that has 6 27-inch screens. And I'm supposedly discretionarily trading all of this. At what point in time in that story does one just call bullshit? I mean, it's just nobody. You're not sitting there playing a video game like with 2 eyeballs looking at 6 27-inch screens, supposedly trading multiple markets and doing all this kind of stuff. It's just complete nonsense.
No, but it sells and it looks sexy and it looks cool and it looks addicting and fun, right? And that's what a lot of the day trading is. It's an addiction. It's to feed part of the brain that feeds off that gets the highs and the lows. I'll be honest. I mean, trend following and trading was more exciting when I first started because of that. I mean, it's exciting trading up and down, watch the values go up and down. But after years and years of doing it now, it's good trading is boring trading. Like, it's just not that exciting. And that's why I don't talk about it much anymore. It's just not that exciting. People ask me, like, what I think about the markets, where I think they're going. I'm like, I don't know. And, I can tell you where I'm positioned. Like, you read off my positions. Like, that's it. Like, those are my views right now, is I'm long those things. I'm short other things because those are the trends. Next month, if we talk again, it'll be a little different. That's it. There's not really a whole lot else to it.
Well, Don, congratulations. Cool story. I love looking at the track record for sure. Unless something happens and you go to zero in the next couple of years, I hope that won't happen. But if you don't go to zero, I can almost guarantee my audience, because of the informational value in this, that when I do get to the 6th edition of Trend Following, I for sure will put your track record in, because it is just informationally, it's so cool, right? You just look at, this decade plus month by month performance, and it just tells you a story. Somebody has to know very little about the markets, but they see March 2020, your company's track record, and they see 56.5%. Now, even if they know very little about the markets, they know, oh, that was when COVID hit. And then the light bulb sparks. Hold on. Why did he make so much money during COVID? I thought everybody got killed. Then another light bulb sparks. And so it's the whole chain. I go back, the first one I ever had like that was looking at early 1995 and kind of deducing that John Henry was, opposite Barings Bank. So those light bulbs, when you can see in a track record and then kind of match it up with what's going on in the real world, severe educational value there. Mr. CFTC regulator, we're having an educational conference. Don does enough disclaimers about his past performance. We all know he could go to zero. His drawdown could be 100% and all that other kind of stuff. I get it. Okay, whatever. So there, I've given you a disclaimer. Okay.
Perfect. Thank you, sir.
Hey, where can we send people? Where can they go to check you and your cool track record out?
So the name of my firm is Purple Valley Capital, purplevalleycapital.com. Named it after I started it in Williams College in the they call them Berkshire Mountains, also known as the Purple Valley up there in northwestern Massachusetts. That's where Purple Valley Capital came from. And you can email me at don@purplevalleycapital.com. I'm open and happy to answer and talk to anybody about any questions or anything about trend following or trading or the performance. I think it's fascinating. I love what I do. I love trend following. I love getting the opportunity to speak with you, having read all your books, and you were very instrumental back in college when I started this. So as always, thank you, Michael, for all your help and advice over the years.
I got to tell you, people, when they look at your business and they look at, you mentioned in this conversation, getting close to 10 million under management, that is, in the grand scheme of money management world, that's a smaller number. I will remind people, and I've said it on this podcast, somewhere buried in a closet somewhere or in a safe somewhere, I have an original paper disclosure document of John W. Henry showing his first month with $16,000 in the account. People need to be careful about placing judgment. Look, David Harding in 1997, it was $5 million under management. I'm almost positive those are the numbers. 1997, $5 million under management.
Right. And John Henry bought the Red Sox just a few decades later. Right.
If you end up buying the Red Sox in the future, you better at least get me some good seats. Because there's sometimes people, it's not a big fund or this or that. Okay, kids. Okay, just settle down. Go look at Don's track record. Take a look. And again, I'm not an agent for anything. Again, educationally, it's just cool stuff. Sir, thank you for coming on. I know I've talked a lot today, but just a really great story.
Always appreciate it. Thank you, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government, and trust Wall Street. This is absolutely not for you.